Most traders believe that finding an edge is the finish line of trading. It's not. Finding an edge is where the real game actually begins. A fake edge can look real, a real edge can look fake, a real edge can disappear, and even a real edge can destroy you if you don't understand the path required to trade it. This is the part of trading mathematics that almost nobody talks about. Everybody's concerned about finding an edge, but no one talks about what happens after you do. This video talks about both. It's not enough to ask if you have an edge. You have to ask 3 harder questions. How is the edge created? How do I know it's real? And what must happen for that edge to survive long enough to be realized meaningfully? That's why in this video, we are going to break down edge mathematics into 3 stages: creation, detection, and realization. Creation explains the mathematical nature of an edge. Detection explains why proving that an edge is real is much harder than most traders believe. And realization explains what happens after the edge exists, when variance, randomness, drawdowns, position sizing, compounding, and trader behavior decide whether the edge actually survives long enough to be fully exploited. Let's begin with edge creation. There are 2 mathematical levers in the creation of an edge: the win rate and the payoff ratio. The win rate is, of course, how often you win in percentage terms. The payoff ratio is the ratio between your average winning trade and your average losing trade. Notice that payoff ratio is not the same as risk-reward ratio. Risk-reward ratio is what you plan to happen in each individual trade. Payoff ratio is the average of what actually happens across many trades. Another way of looking at this is that risk-reward ratio is an input and a strategy design decision. The payoff ratio is an output and a measure of execution quality. For example, let's say you plan to get 1-to-3 risk-reward ratio in each trade, but your payoff ratio across many trades is 2, which means you risk $1 to actually make $2 on average in each trade. This gap between the $3 of profit you aimed for and the $2 of profit you actually got is called edge leak, and it's one measure of execution quality. The reason this happens and how to fix it is a subject for another video. The other mathematical lever is the win rate, and beginners fall for the trap of thinking that higher win rates are better, but that's not true at all. You can make money with a low win rate and lose money with a high win rate. What really matters is the win rate relative to the break-even win rate provided by your payoff ratio. The formula for knowing the break-even win rate is simple: 1 divided by 1 plus P, which is the payoff ratio. In this table, you can see the various break-even win rates associated with each payoff ratio. For example, if you risk $100 to make $300 in each trade on average, your payoff ratio would be 3, and your break-even win rate will be 25%. The next step here is to plot what is called the break-even frontier, which displays the relationship between various break-even win rates and associated payoff ratios. This graph is very useful to visualize the mechanics of edge creation, as you're about to see. Any strategy you can imagine is a coordinate on this graph, and the location of the coordinate determines whether the strategy is profitable or not. Strategies above the line are profitable, at the line they break even, and below the line are unprofitable. So a good strategy is not related to the win rate or the ratio you have. It relates to whether the strategy sits above, at, or below the break-even frontier. Some traders already understand that win rate is meaningless by itself, but they also seem to think that a good ratio automatically creates an edge. It doesn't. It just changes the break-even baseline you have to overcome. For example, let's say you have a strategy with 80% win rate at 0.5 payoff ratio. The strategy will be profitable. If your win rate drops to 60%, the strategy will go below the break-even frontier and it will become unprofitable with the same payoff ratio. In the same way, let's assume you have a payoff ratio of 4, which many traders assume to automatically create an edge, but your win rate is only 15%. The strategy will be below the break-even frontier and it will be unprofitable. Only when it goes above the break-even frontier will it become profitable. This leads us to a more subtle point. If you open many random trades using a specific risk-reward ratio, you'll find that the win rate converges to the break-even frontier. For example, if a random strategy has a very low ratio such as 0.1, it will naturally produce a high win rate for a simple reason. The target is much closer to the entry than the stop. In other words, a high win rate does not mean you are skilled, in the same way that a low win rate doesn't mean you are not skilled. The fact that win rate converges to the break-even rate in a random strategy means that risk-reward ratio by itself does not create an edge. This leads us to the important decision of choosing the optimal ratio. The pitfall here is that this sounds like a mathematical question because we're talking about percentages and ratios, but here's the key. The answer to many trading questions sits at the intersection between multiple fields. The optimal risk-reward ratio is simultaneously a mathematical, technical, and behavioral question. We already saw the mathematics. In terms of technique, the optimal ratio depends on the type of strategy you trade. For example, mean reverting strategies work better with lower ratios, and consequently higher win rates. If you aim for higher ratios in that type of strategy, you'll create unnecessary losing streaks and give back profits unnecessarily. Trend following strategies, however, work better with higher ratios and consequently lower win rates. If you aim for a low ratio in that type of strategy, you'll leave precious gains on the table. The infrequent large profits are what creates an edge in that setting. The bottom line is, different kinds of strategies ask for different ratios. The third part of the answer of what is the optimal risk-reward ratio is behavioral. High ratio low win rate and low ratio high win rate produce very different psychological burdens on the trader, and you must be aware of which one you are more likely to endure. Let's imagine the extremes to make this point as clear as possible. An extremely low ratio creates the necessity of being right constantly, which will happen for a while, creating positive reinforcement and increasing confidence. And when the losing trade comes, the trader has to deal with a large loss that is financially and psychologically devastating. On the other hand, an extremely high ratio creates very long losing streaks with occasionally profitable trades that compensate for it. The problem with that is that even though each losing trade in a losing streak is small, the repeatable failure slowly kills the trader's confidence in the strategy before the edge has time to emerge. So it's not only about the type of strategy and market scenario you want to exploit, but it's also about the type of psychological burden you want to endure. We're talking about the extremes here, which you should avoid, but how you gravitate the middle of this graph is dependent on these three dimensions: mathematics, technique, and behavior. If you prefer the pressure to be right more often rather than fighting to maintain confidence over losing streaks, you'll be better off with a mean reverting strategy. If you can tolerate longer losing streaks, knowing the edge will emerge eventually, you'll be better off with trend following. So the mathematics tells you how these variables work and what's possible. Your psychological preference determines the strategy type and consequently the optimal ratio for you. This finishes the part of edge creation. In summary, the two most important mathematical variables in edge creation are the win rate and the payoff ratio. The gap between risk-reward ratio and payoff ratio represents edge leak. Risk-reward ratios don't automatically create an edge. They just change the baseline break-even level you must overcome. You can make money with a low win rate and lose money with a high win rate. The optimal risk-reward ratio is not just a mathematical question. It's also a technical and behavioral question simultaneously. Your psychological profile must determine the type of strategy you trade. The main point of this first part is that edge creation is not just about mathematics. It's also about technique and behavior simultaneously. That's why there is no universal best risk-reward ratio. You must be honest with yourself to find out what ratio fits your trading profile. That's the key. If you like the content so far, don't forget to click the like and subscribe if you haven't already. We move on now to the second part, which is edge detection. Objectively detecting an edge is done through the expectancy formula in mathematics, which combines the two main variables of an edge, win rate and payoff ratio. For example, let's say you have a 35% win rate, which automatically translates into a 65% loss rate, with an average winner of $300 and an average loser of $100. This gives you an expectancy of $40. Expectancy is basically an average of what you can expect in each trade, given your win rate and payoff ratio, which are greatly impacted by risk-reward ratio as we saw previously. For your edge to exist, expectancy must be positive. If your expectancy is negative, there is no amount of discipline in the world that is going to make you profitable. With that said, when you're calculating your edge through the expectancy formula, there are two pitfalls. The first pitfall is related to sample size. If you are calculating your expectancy based on the last 10 trades, it's one thing. If you are calculating it based on the last 300, it's another thing entirely. The smaller the sample of trades you use to calculate expectancy, the less you can trust the number that comes out of the expectancy formula. For example, if you calculate it using the last 10 trades and you happen to be on a winning streak, the expectancy formula will tell you you have an amazing edge. In a larger sample of trades, your edge will be calculated considering winning streaks, losing streaks, and flat periods, and the formula will give you a much more realistic result. This is why the law of large numbers matters a lot in trading. The law of large numbers in statistics says that as the number of observations increases, the sample average tends to converge toward the true expected value. So the more trades you have, the less your expectancy estimate is dominated by random streaks, and the more you can trust it. This is the antidote to the beginner who feels like he has an edge because he was right in the last few trades. There's nothing like the visual representation of an idea to make things crystal clear. Take a look at the small sample of trades within a larger equity curve. If you calculate your expectancy based on this, you'll be convinced you have an amazing edge. However, as we reveal the equity curve, it becomes evident that this was just a small winning streak inside the larger context of a losing strategy. The second pitfall is also in the way most traders calculate the edge formula, which is in absolute dollar terms. This ignores the most important part of your trades, which is the risk you took in order to generate them. For example, if you risk $100 to make $500, it's one thing. But if you risk $1,000 to make the same $500, you have a much different situation. We are talking about the same $500 of profit, but the risk, and therefore quality of the trade, is vastly different. That's a key point. Traders associate profits with edge quality. That's wrong. Edge quality has to do with the risk taken to generate profits. This leads us to the idea of R multiples, which was popularized by Van Tharp in his famous book, Trade Your Way to Financial Freedom. The idea is that each trade should not be expressed in dollar terms. It should be expressed in multiples of the initial risk in each trade. So for example, if you risk $100 in a trade, that's your R. If you made a profit of $250, that would be 2.5 R. If you were stopped out, that would be minus 1 R. In another trade, if you risk 80, that's your R in that trade. If you make a profit of 200, that's 2.5 R. So to know your expectancy in terms of R multiples, all you need to do is to calculate the average of your R multiples. Consider now an example where we have two strategies producing the same amount of profit in dollar terms, but with different R expectancies. Both traders have a dollar expectancy equal to 100. However, Trader A has R expectancy equal 3, and Trader B has R expectancy equal to 0.0125. Trader A has a stronger edge traded at a smaller size. Trader B has a razor-thin edge made to look meaningful by taking larger risk. In summary, dollar expectancy shows the quantity of edge given your position size. R expectancy shows the quality of your edge, which is a much more meaningful metric. Another way of looking at this is that R expectancy measures the edge quality independently of position size or dollar exposure. Another fact about edge detection is that it's possible to have positive dollar expectancy while having negative R expectancy when position size varies drastically across trades, which illustrates how misleading and dangerous it is to ignore risk and only look at the P&L. This example shows how mathematics can warn you about the danger of an unhealthy strategy while the P&L is still positive. In summary, detecting an edge through expectancy has two traps to avoid: small samples and confusing edge quantity with edge quality. Small samples can make randomness and variance look like skill. Dollar expectancy can create the illusion of skill in a strategy that is bound to fail due to negative R expectancy. We move on now to the third part, which is about edge realization. Creating and accurately detecting an edge is meaningless if the trader cannot realize it. Edge realization has two sides, preservation and extraction. Preservation splits into two main issues, trader survival and edge survival. Extraction begins once preservation is secured. It's the problem of converting a preserved edge into meaningful account growth. The trader must balance geometric growth against opportunity cost. In other words, it's not enough to have a profitable strategy. It needs to be profitable enough to make the capital, time, and effort put into it worthwhile. Let's begin with preservation, talking about trader survival. You may think that the fact that you must be able to survive your own edge is weird, but it's true. You can have positive R expectancy and still lose money because the edge expresses itself through an uncertain path, meaning an uncertain sequence of trades, and the trader's reaction to that path can destroy the edge before it has time to play out. A strategy may have positive average result over 300 trades, but that does not mean the next 10 trades will be profitable. The next 10 trades could all be losers. The next 30 trades could produce a drawdown, and the next 50 trades could make you question whether the edge still exists. This is where traders confuse the average with the path. Positive expectancy tells you that the distribution is favorable, but it does not guarantee that the distribution will express itself smoothly, quickly, or comfortably. This is where the survival problem begins. You need to stay solvent and psychologically stable long enough for the edge to actually show up in your results. So bad trading behavior can still destroy a mathematically valid strategy. Calculating the R expectancy of a strategy across a sufficiently large sample tells you whether its distribution of outcomes has been favorable to you, at least over that period. However, that's a mathematical abstraction that doesn't reflect the experience of trading. In practice, traders do not experience expectancy directly. They experience the compounded dollar outcome of a sequence of trades they produce, and this sequence of trades has some interesting properties. The first obvious property of the sequence of trades is its roughness, which in this context we call variance. The more violently the trade sequence oscillates, the higher its variance. This is important because two strategies can end up leading to the same result, but produce completely different trading experiences. One may climb relatively smoothly, while the other may have deep drawdowns, violent recoveries, and long periods of frustration. In other words, variance tells you how painful and unstable the path may be. The main variable that controls variance is position size, which we'll explore later. The second property is randomness. In this context, randomness means that even when the distribution of outcomes is favorable, the result of the next trade remains unpredictable. In other words, your strategy cannot predict what the market will do after you enter the trade. Variance describes how rough the sequence of trades can be. Randomness determines how those trades are arranged through time. One interesting way of looking at this is that if the same trader with the same strategy restarts the sequence of trades, it will look different every time he does it due to randomness. There is also a feedback loop between the trader and the trade sequence. The trader generates the sequence, but the sequence then changes the trader's emotional state, confidence, risk tolerance, and decision making. In that sense, the trader is not only producing the path, he is also being shaped by it. Trader survival, then, is not only about having a positive edge. It's about being able to remain financially and psychologically stable through the unavoidable randomness and variance of the path through which the edge expresses itself. That closes the part related to trader survival. The other half of edge preservation is about the survival of the edge itself, which is related to the phenomenon called edge decay. Edge decay relates to the undeniable fact that trading edges can and often do disappear without warning. Sometimes a strategy stops working not because the trader made a mistake, but because the market itself has changed. Volatility changes, liquidity changes, market structure changes, participants adapt, and strategies become crowded. A setup that once had positive expectancy can slowly or abruptly lose its edge as the environment that supported it disappears. The tricky part is that edge decay can look almost identical to a normal drawdown inside a valid edge. Both can produce losses and both can make the trader question the strategy, but they require opposite responses. If the edge is still valid and you are simply experiencing normal variance, The correct response is to keep executing. If the edge has actually decayed, the correct response is to stop, adapt, or rebuild the strategy. An edge is not invalidated by losing trades. It is invalidated when the recent sequence of trades becomes inconsistent with the distribution and logic that made the edge favorable in the first place. This is one of the hardest problems in trading, knowing whether the pain you are experiencing is the normal cost of a real edge or evidence that the edge is no longer there. A lot of traders are shocked when they discover that edges can disappear, especially beginners. But the sooner you learn and accept this, the better off you'll be. There are deeper mathematical reasons for this, but that's a matter for another video. The irony is that finding an edge is often easier than knowing whether the edge is still there. In summary, having an edge does not guarantee profitability. The trader still needs to survive the feedback loop between him and the sequence of trades, and beyond that, the edge must survive the ever-changing market environment. We move on now to the other half of the problem of edge realization, which is edge extraction. Survival is necessary, but it's not sufficient. Let's say you manage to preserve yourself and your edge through a long sequence of trades, and you end up making some profit. That does not mean your strategy is worth trading. Most traders are surprised to hear that, and that's because they think in terms of financial cost only. However, the deeper question is not whether your strategy is profitable in the long run. It's whether this profit compensates the opportunity cost of trading your strategy. In this sense, the opportunity cost is the result that the time, capital, and effort you put in trading your strategy could have produced elsewhere. The classic example is this. A trader can usually get a decent annual return by passively investing his money on a market index or even a fund that aims to beat the market index. It requires almost zero time and effort, so if he's going to put time and effort to trade his own strategy, he better be able to produce a better result than the benchmark. I explain more about that in my premium course called Fractal Trading, Mastering Price Action and Beyond. The point for this video is that extracting as much as possible from your edge is not just something you want to do, it's something you need to do. That becomes very clear once you start thinking in terms of opportunity cost, rather than just assessing whether you are profitable in the long term. Whenever we talk about the maximization of account growth, we must talk about compounding and its properties. Compounding allows gains to increase the capital base from which future gains are earned. As the account grows, the same percentage return produces larger gains in dollar terms, allowing growth to accelerate over time. For example, if you make 10% on 100,000, you make 10,000. But if your account grows to 110,000, the next 10% gain produces 11,000. The percentage return is the same, but the dollar result is larger because the capital base has increased. This is the great sign of compounding. Growth begins to fit on itself. That sounds good, but it depends on preserving the capital base that makes future growth possible. Drawdowns can interrupt or reverse the compounding process by shrinking that base and increasing the return required to merely recover. For example, if your account falls from 100,000 to 80,000, a 20% gain no longer produces 20,000, it produces 16,000. Recovering from a drawdown like this leads us to the idea of asymmetric returns, which illustrates how our intuitions can be misleading in this regard. For you to recover from a 20% drawdown, you need more than 20% return because you are recovering from a smaller capital base. In this case, you actually need 25% to recover from a 20% drawdown. We can calculate the recovery return given a drawdown using the following formula. Another important detail is that the relationship between the drawdown return and the recovery return is nonlinear. An extreme 90% drawdown requires 900% to recover, making it nearly impossible to do so. This graph shows the recovery return as a function of drawdown. Notice how it's an exponential curve. In other words, the larger the drawdown, the harder it is to recover from it, but in a nonlinear way, which exceeds our rough intuition about how this works. Difficulty of recovery is one side of this, but this problem of course exists when negative returns kill recent profits. For example, let's say you went from 100,000 to 120,000, so a 20% return. To kill that return and go back to 100,000, you only need a negative 16.67% return. The bottom line is that this asymmetry works against you whenever your equity falls from a reference point. Another misconception in the way traders measure their results is to use arithmetic average to gauge average return. For example, let's say you made 20% return followed by a negative 20% return. If you calculate the arithmetic average, you reach the conclusion that your average return was 0%, but that does not reflect your account because you did not go back to even. You actually lost money. To really get an average of your returns, you must use the geometric average, which considers the fact that trading returns are multiplicative rather than additive, and therefore it's a more realistic measure of average return. This is called volatility drag, which can be defined as the gap between arithmetic and geometric average return caused by the variability in returns. The geometric average is lower because returns compound asymmetrically. Variance fuels this process. If you get 40% and then minus 40% return, which is double the variance, you'll have a geometric average return of minus 8.35% rather than minus 2.02%, while arithmetic return remains 0%. So twice the variance creates roughly 4 times the drag. Notice that the relationship between variance and volatility drag is nonlinear. In practical terms, the sequence of trades with more variance will usually compound worse because of volatility drag. The key insight here is this. If we compare two sequences of trades with the same arithmetic returns, the sequence with lower variance will produce a higher geometric return. In even simpler terms, consistent moderate returns can outperform occasional large gains accompanied by large fluctuations because they suffer less volatility drag. Edge extraction, then, is the problem of finding the highest sustainable rate of growth in order to compensate for the opportunity cost of trading a profitable strategy. That also means aiming for the highest possible absolute return while minimizing the standard deviation of returns in order to avoid volatility drag as much as possible. So far, we have the following. Positive R expectancy gives you a favorable distribution. Randomness determines the sequence. Variance determines how rough the path can be. Drawdowns show the damage in the account. Risk of ruin is the possibility that the damage becomes terminal. Compounding is how growth happens. Volatility drag is how variance impairs compounding. Opportunity cost determines whether long-term profit is worthwhile. Given all these ideas, we can now focus on the problem that position sizing tries to solve. Position sizing is not just about deciding how much money to put into a trade. It is the mechanism that connects edge, randomness, variance, behavior, compounding, volatility drag, and opportunity cost. It's the balancing force between survival and growth. If you size too aggressively, you may extract more from the edge in the short term, but you also magnify drawdowns, increase psychological pressure, raise the risk of ruin, and damage the compounding process through volatility drag. If you size too conservatively, you may survive easily, but the edge may not compound in a meaningful way. The account stays safe, but the growth potential of the edge is underutilized, and the strategy may not be worth trading even if it's profitable due to its opportunity cost. The classic mathematical answer to this problem is the Kelly formula. This is the money management formula used by Larry Williams to win the 1987 World Trading Championship with the greatest return in history. Kelly answers one central question. Given a strategy with a known edge, what fraction of capital should be risked to maximize long-term geometric growth? Remember that trading returns don't add up, they multiply. This is why Kelly connects directly to everything we have discussed. It's not just about avoiding losses, it's about balancing survival and growth. Risk too little, and the edge does not compound efficiently. Risk too much, and normal variance can create destructive drawdowns, volatility drag, psychological pressure, and even risk of ruin. So for example, if you have a 45% win rate and your payoff ratio is 2, the Kelly formula tells you to risk 17.5% of your capital in each trade to maximize geometric growth. At a first glance, this seems like a lot, and it is. Most traders don't have the tolerance to risk 17% of their capital in every trade. This is also where Kelly becomes dangerous. The formula assumes that you know your probabilities, your payoff distribution, and your edge with much more precision than most traders actually do. In the real world, Your win rate changes, your payoff ratio varies, slippage exists, market regimes shift, and the edge may simply decay. Win rate and payoff ratio are not constants in any strategy. They are a range of values, assuming the edge remains intact. So Kelly gives us the theoretical answer to position sizing, but not necessarily the practical answer. It teaches the central principle. There is an optimal size for growth, and oversizing an edge can be worse than undersizing it. But because full Kelly can produce drawdowns, most traders cannot financially or psychologically tolerate. Practical traders often use fractional Kelly instead. This is actually the starting point of correct position sizing calculation, but that's a more advanced topic for another time. Notice that we covered many treacherous facts about trading edge. A fake edge can look real, a real edge can look fake, a real edge can destroy you, a real edge can disappear, a real edge is not automatically worth trading, the same edge can be safe at one size and lethal at another. An edge can stop working before the evidence becomes statistically obvious, and the best edge is not necessarily the strongest edge, but the one you can survive and consistently extract. This serves the purpose of showing you that in trading, things are usually not what they seem to be. Let's finish this video by looking at how prop firms capitalize on the treacherous mathematics of trading. In a retail prop firm model, the firm's main revenue usually does not come from commissions or profits generated by traders in the real market. It comes from challenge fees, resets, subscriptions, activation fees, and repeated failed attempts. Many funded accounts are simulated accounts with a payout contract attached to them. Successful traders are often paid from the firm's general revenue pool, which is largely funded by unsuccessful traders who repeatedly buy challenges, fail, reset, and try again. In this sense, prop firms redistribute money within the real trading ecosystem. The fees paid by the majority fund the payouts of the minority, while the firm keeps the remainder. This makes the model resemble a gamified trading competition more than genuine speculation. Most participants are not deploying their own capital into the market or bearing its full economic consequences. The mechanism works because a prop challenge compresses the question of edge into a very small sample of trades dominated by variance and randomness. A trader does not need to demonstrate durable positive expectancy over hundreds of trades. He only needs to reach a profit target before hitting a drawdown limit. As a result, luck can look like edge, and edge can look like failure. Passing does not necessarily prove that a trader has a durable edge, while failing does not necessarily prove that he lacks one. Almost every combination of skill and luck can therefore benefit the firm. With no skill and bad luck, the trader fails, assumes he made mistakes, and tries again. With no skill and good luck, the trader passes, mistakes luck for skill, eventually loses the account, and tries again. With skill and bad luck, the trader fails, attributes it to variance or randomness, and tries again. With skill and good luck, the trader passes, feels validated, and buys more accounts to scale up, but also receives payouts, which diminishes the firm's profit. In a fee-driven model, consistently profitable traders who extract more than they pay are liabilities to the firm. The ideal customer is the unsuccessful trader who continues buying challenges because a favorable short-term result has created the illusion that he possesses a durable edge. Prop firms monetize the gap between short-term validation and long-term statistical proof. This is also why prop trading and trading your own capital are fundamentally different games. Prop trading rewards reaching targets, avoiding rule violations, securing payouts, and adapting to the geometry of the payout structure. Trading your own capital rewards survival, capital preservation, emotional control, risk-adjusted growth, and long-term compounding. A successful prop trader may therefore be poor at managing personal capital, while a strong independent trader may struggle with prop challenges. They may appear to be doing the same activity, but they are optimizing for different objectives. Trading your own money is the more honest test of trading ability because there are no resets, no simulated payout contracts, or artificial targets. You bear the full consequences of your decisions. Prop firms are a legitimate business and can be useful for traders seeking access to capital, but traders must understand what they are actually being tested on. Prop challenges test technical adaptation to a payout structure. Trading your own capital tests whether you can manage risk, survive variance, control yourself, and compound over time with genuine skin in the game. The subject of mathematics extends its tentacles into many different parts of trading, as you were able to see, hopefully. But this video provides you with a backbone that will save you a lot of time and money and avoid a lot of frustration. If everyone knew these concepts, the real trading landscape would definitely be much better. If you like the content I produce and wish to go deeper into advanced trading, please check out my premium trading courses and ebooks. You can find more information in my website, fractalflowpro.com, or send me an email directly at support@fractalflowpro.com. If you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications, leave your comment below, and share this video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.